Unless you're hiding under a rock somewhere, you've noticed that Tesla has rallied hugely lately, up over 55% from October 1st to November 1st, with its price going through the roof after they released their third quarter earnings report, pushing up over $1,200 for a short period of time in less than 2 weeks. I'm Seth Froyberg, the head trader of S&B Capital's options trading desk here in Manhattan, and the traders on our desk are keenly aware of the fact that when stocks push up that hard and that fast, there's almost inevitably a pullback that takes place as market participants take profits. In today's video, we're going to be showing you a surprisingly powerful technique for taking advantage of these pullbacks, so stick around. I think you're going to be surprised how easy this is to learn. Hi, I'm Seth Froyberg, and I'm the head trader of S&B Capital's options trading desk. S&B Capital is a proprietary trading firm located in Midtown Manhattan. We provide capital for options and equity traders from all over the world, trading both remotely and in our offices here in New York City. I'd like to suggest that you click on our subscribe button right now so that you don't miss any of our free trading videos that we produce for traders and investors all over the world. They're really very valuable. Okay, so by now everyone knows that Elon Musk is the new richest guy in the world, based largely on his Tesla shares, which skyrocketed recently, as you can see. From October 1 through November 1, the stock was up over 55%, an incredible run for a stock which had already been performing in spectacular fashion for years now. And of course, when these kinds of things happen, there's typically a round of profit taking, and sharp traders are more than aware of that possibility and have learned how to respond to those pullbacks using options in a way that can be very profitable if executed properly, and at the same time doesn't require you to know the exact nature and depth of the pullback, but instead is built very flexibly so that a pullback over a very wide range of prices can present a tremendous profit opportunity. But before we get into how to implement a strategy to take huge advantage of a pullback in Tesla shares, I wanted to let you know that if you want to learn 3 option strategies that our pro traders use, including the unique options trick that allows you to make money while you wait to buy stocks or ETFs at the price you want, and the options income strategy that allows you to make consistent money whether the market goes up, down, or sideways, and how to make money on a stock or index trade even if you're outright wrong on direction, then click the link that should be appearing now at the top right corner of your screen. That's going to open up a free workshop registration page in a new window, so don't worry, you won't lose this video. Or you can register directly for free at optionsclass.com. Believe me, you don't want to miss this, so pause this video, sign up now, and then resume watching. Okay, now the strategy that we're about to teach you involves the use of stock options, and I want to make sure that everyone watching the video understands how stock options work. For those of you who do understand stock options, just hang in there. This is going to be quick, and then we'll get right back into teaching you the details of the strategy. Okay, so what's known as a call option on a stock entitles the buyer of that option to purchase 100 shares of that stock at a certain price called the strike price of that option, regardless of what price the stock is actually trading at any time before that option expires. What's called a put option, on the other hand, entitles the buyer of that put to sell 100 shares of a stock he owns at the strike price of that put, again, regardless of what price the stock is trading at any time before that option expires. The buyer of the option pays what's called a premium to the seller of the option because the seller is taking the risk that the stock will go past the strike price of the option, in which case the buyer can exercise his option. So in the case of a call, even if the stock's gone way above the strike price of the call buyer can exercise his right to buy 100 shares at that strike price. In other words, he's entitled to buy the shares way below where they're trading in the market. He could flip them the next minute, for example, and make a huge profit on those shares in that case. Or conversely, on the put option, even if the market goes way below the strike price of the put option, the buyer of that put option has the right to sell his shares of that stock at the strike price of the put option that he's bought, even if the stock price has gone way below the strike price of the put, which effectively puts a floor on how much he can lose owning that stock. Now, on the other hand, at expiration, if you've sold a call and the market closes below the strike price of the call, then unless the call was previously exercised, the call actually expires worthless and the call seller just pockets the premium he received. Similarly, if you've sold a put and the market closes above the strike price of that put, then unless the put was previously exercised, again, it expires worthless and the call seller just pockets the premium. With that as background, let's take a look back at January of this year to draw an analogy to the current situation with Tesla. And as you can see, from a percentage perspective, what happened in 2020 was even more amazing, as this stock, in the midst of a pandemic, rallied almost eightfold during the year. And so a trader could have reasonably been concerned heading into the new year that there might be some profit taking before Tesla takes its next leg up. And so let's move to the first week in January of 2021, and we'll take a look at, on January 7th, an options chain that expires a few months out on March 19th. And so on that day, if we were to sell 10 of those 810 calls and also sell 10 of the 600 puts, and then as protection, we would buy 10 of the 830 calls and buy 10 of the 580 puts, that entire combination is what is known to an options trader as an iron condor. And you'll see shortly why this is a strategy that a trader would employ if he thought that Tesla was likely to pull back into the 600 to 810 range in the coming months. Now, before we explain how and why that happens, let's first take a look at the cash flow implications of entering this trade. And as you can see, we start with what we received for the 810 calls, and the price for those options were $104.65. But remember, each options contract represents 100 shares of Tesla stock. So you multiply that by 100, and we sold 10 of them. So the total that we received for selling those calls is $104,650. But then we turn right around, and using the same concept, we pay $96.48 for buying those protective 830 calls. And so that actually cost us $96,480. Now, focusing on the put side of the trade, you see we brought in $22,450 for those 600 puts that we sold, and we pay back out $18,830 for the 580 puts that we bought for protection. So when you net it all down, it comes to a total cash inflow to our account of $11,790. Now, your broker is going to require you to have at least 82.10 to execute this trade, which is the worst loss possible if the trade doesn't go as expected. Now, you may be wondering, why in the world would we construct this iron condor trade if we think that Tesla is likely to experience a pullback over the next few months? And so let's move forward to the day that these options actually expire, which is March 19th, 2021. And this will become more clear to you. As you can see, as the trader had anticipated, Tesla had indeed sold off after an initial rally up to 900 in January. And it closed on March 19th at 652. So now, this being the day that the options expire, let's analyze how this iron condor performed in this circumstance. And so remember, these options expire on March 19th, and so the settlement value of these options can be finally calculated on that day. So when we look at the 810 and 830 calls, we see that they expired 158 and 178 points respectively above Tesla's closing price on that day, which means that the options expired with no value, because there's no point in someone exercising a call with the right to buy shares at a price way above where they're actually trading on the day they expire. So those just expire worthless. And the same is true for the puts down at 600 and 580. They also expire worthless, because no one is going to be exercising their right to sell Tesla shares at 600 or 580 if they're trading at 652 in the open market. And so those go out worthless as well. But remember, we received initially $11,790 for entering into this trade in the first place. So the profit on the trade is exactly that original $11,790 that we got in. And that constitutes a return of over 143% in a little over 2 months. That's not bad. And there's one more point I'd like you to focus on, and that is the fact that at any price between 680 and 810, you would have had the same outcome. Why? Well, think about it. Regardless of how close the calls are to 800, even if they close on expiration day at $7.99 and 99 cents, Unless they're over 800, they expire with no value because no one's going to exercise their right to buy something more expensively than they can go out and buy it in the open market. And even if Tesla closes at $600.01, again, both the 600 and 580 puts would have expired worthless because, again, there's no value at all to a right to sell something below where you could sell it in the open market. And so what I'd like you to take away from today's video is that there is an options strategy called the Iron Condor, where all that you have to do in your trading judgment is to get the general range right of where a stock will be in 2 months. And that can be a pretty wide range, as you can see from this example of over 200 points wide. And still, you can get a massive return over any point in that entire range. You don't have to know exactly where the pullback will go. You just have to be right that it will generally pull back and have a very general idea of what range you think the stock is likely to pull back into. And then it's extremely simple to structure a trade to make a great return by placing the Iron Condor elements above and below that range. And as I said, that can be a really wide range, giving you a lot of room for error, even if you don't get the parameters of the pullback perfect, which is going to be almost impossible to do anyway. But to formulate an opinion about what general range the stock may pull back into, now that's a lot more doable. And these are the kinds of strategies that professional options traders use all the time to express their judgment as to the very wide future range of a stock or an index. Just to remind you, if you're serious about your trading, you need to check out the free intensive options class that we're currently running, where you'll learn 3 real-world option strategies that our professional options traders use all the time. Just click the link that should be appearing now at the top right corner of your screen, or you can just head on over to optionsclass.com to register for this free workshop directly. It really is a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now before you miss it. And please don't forget to hit our subscribe button right now so that you don't miss any of our free training videos to help you to up your game as an options trader.